Welcome to another deep dive with us. This time, we'll be exploring the world of financial markets.
Exciting stuff.
It is. We have some fascinating academic texts from the Indira Gandhi National Open University that you sent us all about financial technologies and markets.
Oh yeah, those were dense.
They were, but also really interesting. We're going to be uncovering some pretty cool historical stuff like the first recorded asset bubble tulip mania.
Wild times.
They were. And we'll also be touching on India's own stock market scam from 1992.
Some valuable lessons there.
Absolutely.
Yeah.
So let's jump right in. Now, I know you're already pretty familiar with the basics of financial markets, but what stood out to you in these sources about their core purpose? Like, how do they actually work?
Well, the real emphasis for me was on financial claims.
Oh, financial claims. That's a term we often hear but don't really grasp, right?
Exactly. And these texts explain it beautifully. They're essentially like IOUs.
IOUs, okay.
Yeah, they represent your right to future benefits.
So it's not just about the physical money changing hands.
Right. It's more about these claims on future value.
So let me see if I get this. Even something like a simple savings account involves a financial claim.
Absolutely.
Yeah.
You have a claim on your deposited funds, plus the interest you accrue.
Okay, I'm starting to see it.
And, every financial decision you make, from buying a house with a mortgage to investing in a mutual fund, is basically acquiring or trading these financial claims.
That's actually a really interesting way to think about it. It makes it all feel more tangible. Now, I loved how the source material took us on this fascinating historical journey, starting way back with the organized financial markets in the Roman Empire.
Yeah, tracing the evolution of global markets is fascinating.
Totally.
From those Roman marketplaces to Venetian bankers trading government securities to European fairs where shares were actively traded. It's like this continuous thread that led to modern-day Wall Street.
It's incredible. And then there's tulip mania. Can you believe it? The 17th century Dutch bubble where single tulip bulbs were selling for the price of houses.
It's hard to wrap your head around that.
It really is. What insights did you get from the source material about this historical event?
Tulip mania is like this classic example of how market psychology comes into play. People got caught up in the frenzy, totally driven by speculation and the fear of missing out.
FOMO.
Yeah, FOMO from way back then. And the source highlights that understanding this psychology, the herd mentality and emotional biases that can drive markets, is absolutely crucial, even today.
So true. It's a reminder that markets aren't always rational.
Not always, no.
Absolutely. It seems like human nature itself plays a big role in market bubbles. Now let's shift focus a bit to the evolution of Indian financial markets. The source material points out some key milestones, starting with the establishment of major stock exchanges like the Bombay Stock Exchange.
Yeah, setting up those exchanges really marked a turning point for Indian finance.
I can imagine.
And, you also have significant historical events like the 1992 Harshad Mehta scam, which exposed vulnerabilities in the system.
Right.
And, as the text explains, ultimately led to some much-needed regulatory reforms.
It's amazing how one event can trigger such significant changes.
It really is.
And of course, the introduction of SEBI, the Securities and Exchange Board of India, was a game changer.
Oh, yeah, totally. In terms of investor protection and market integrity, it was huge.
For sure. SEBI's role is absolutely crucial. The source material details how they regulate everything from IPOs to trading practices, all to ensure transparency and fairness for investors.
It's vital.
So in a way, SEBI acts as a kind of watchdog, safeguarding investors from potential manipulation or unethical practices.
Precisely.
Speaking of the Indian financial ecosystem, it's definitely a pretty complex landscape. Can you break down the key players and their roles based on what you gathered from the source?
Sure. So you have the Reserve Bank of India, or RBI.
The RBI.
Our central bank responsible for monetary policy and overall financial stability. Then you have SEBI, focusing on regulating the securities market and protecting investors.
And how do these entities actually impact the average investor, like our listener, in their day-to-day financial life?
Well, take SEBI, for example. They mandate disclosures from companies.
Disclosures.
Yeah, ensuring you have access to reliable information before you invest in a stock. They also monitor trading activity to prevent insider trading and market manipulation.
To protect our interests as investors.
Exactly.
That definitely makes me feel more secure, knowing there are systems in place to promote fairness and transparency. Now let's dive into the distinction between primary and secondary markets, something that can be confusing for even seasoned investors.
Yeah. Good point.
So think of the primary market as the birthplace of new securities.
Okay.
It's where companies issue IPOs, those initial public offerings, to raise capital for the first time.
Right.
They also might issue FPOs, follow-on public offerings, to raise more capital.
Makes sense.
So in the primary market, you're essentially buying shares directly from the company.
Got it.
But the source material also mentions something called private placements. What's that about?
In a private placement, the company sells shares to a select group of investors rather than to the public.
Interesting.
It's another route for raising capital. And then we have the secondary market, where investors trade those already existing securities among themselves.
Got it. So the New York Stock Exchange, the Bombay Stock Exchange, those are examples of secondary markets.
Exactly.
And within those markets, there are so many ways for companies to raise capital. The source material talks about book building, but to be honest, that always sounded kind of like a black box to me. Can you shed some light on how that process actually works?
Well, book building is really fascinating.
Okay.
So instead of setting a fixed price for their IPO, companies use book building to gauge investor demand. They collect bids from potential investors, essentially asking how much they're willing to pay for the shares.
So it's like an auction.
It is. It lets those market forces determine the optimal price for the IPO.
That's actually quite clever. And what about the secondary market? Why is that so important for investors?
Well, the secondary market provides liquidity.
Liquidity, right.
It allows you to easily buy or sell your investments. If you held a share of a company that only traded in the primary market, it would be much harder to find a buyer when you wanted to sell it.
That makes sense. The secondary market allows for more flexibility and accessibility. Now, I really loved how the source material went into the historical evolution of trading, from that chaotic open outcry system to those sleek electronic trading platforms we use today.
Oh, yeah. The shift to electronic trading has been revolutionary.
For sure.
It's made trading more efficient, transparent, and accessible. You can place trades with a few clicks, and the order execution is almost instantaneous.
I know. It's amazing how far we've come. I remember reading about those old trading floors where it was all shouting and hand signals. Sounds intense.
It was quite a scene.
But now you can trade from anywhere in the world with an internet connection.
Exactly. The world at your fingertips.
Speaking of the world, financial markets are inherently risky. The source material outlines various types of risk, starting with market risk. Can you give us a quick overview of that concept?
Sure. Market risk is basically the risk of your investments losing value due to broader market movements. Essentially, it's the uncertainty that's inherent in the market itself.
So even if a company is performing well, its stock price could still drop due to external factors affecting the overall market.
Exactly. And within market risk, we have systematic risk. That's inherent to the entire market and can't be eliminated through diversification.
What do you mean by that?
Well, think of something like a global recession or a sudden political crisis. These events impact almost all companies, regardless of their individual performance.
That's a bit of a sobering thought. So even with a diversified portfolio, you're still exposed to this systematic risk.
You are. It's unavoidable.
The source material uses the 2008 financial crisis as a prime example of systematic risk in action. Can you connect the dots for us?
Well, the 2008 crisis started with the collapse of the U.S. housing market.
Right.
But as the source material explains, this seemingly isolated event was amplified by the interconnected nature of global financial systems. It triggered a chain reaction that impacted markets worldwide.
Wow.
It's a stark reminder of how systematic risk can affect even the most carefully crafted portfolios.
That's for sure. It really highlights the importance of understanding these broader risks and having a strategy to manage them. It really does. Now, the source material also touches on some more advanced concepts that I found really intriguing, particularly the efficient market hypothesis.
Ah, yes.
Can you break down what that's all about?
So the efficient market hypothesis basically suggests that a stock's price already reflects all available information.
Okay.
Imagine you're spending hours poring over financial statements, trying to find an undervalued stock.
Right.
The efficient market hypothesis says all that work might be totally futile because the market has already priced in that information.
So it's saying that trying to consistently beat the market is kind of a game of chance.
Yeah, pretty much. It challenges that whole idea of active investing.
It certainly makes you think. Now, another concept that the source material covers is the capital asset pricing model.
CAPM.
CAPM, right. What are the key takeaways from that model?
Well, CAPM essentially links risk and expected return.
Okay.
It suggests that a riskier investment should offer a higher potential return to compensate for that added risk.
Makes sense.
Think about it. Would you invest in a super risky startup if you could get the same potential return from a well-established company?
Probably not, no.
Probably not. Investors need an incentive to take on more risk.
Right, but how does CPM actually work in practice?
Well, it basically provides this framework for calculating the expected return on an investment based on its systematic risk.
Okay.
It's a tool that analysts and portfolio managers use to evaluate investment opportunities.
So CPM gives us a way to actually quantify that relationship between risk and return.
It does.
Now, the source material also dives into behavioral finance, which I always find so fascinating. It explores how our psychological biases can influence investment decisions. Can you elaborate on that?
Yeah. Behavioral finance acknowledges that investors aren't always perfectly rational.
We're human.
Exactly. We're all susceptible to emotional biases.
Like what?
Well, for example, there's loss aversion,
Loss aversion.
where the pain of a loss feels more intense than the pleasure of an equivalent gain.
Oh, interesting.
And this can lead investors to hold on to losing investments for way too long, just hoping to avoid realizing that loss.
It's interesting how emotions can cloud our judgment, even when it comes to money.
Ah.
Are there any other examples of biases that can really impact investors?
Oh, there are tons. Another common one is confirmation bias.
Confirmation bias.
This is the tendency for us to favor information that confirms our existing beliefs
Yeah.
while ignoring evidence that contradicts them.
We all do that.
We do. And it can lead investors to make decisions based on gut feelings rather than, objective analysis.
That's a really good point. It's like we're programmed to seek out information that just reinforces what we already believe, even if it's not the most rational approach.
It's a very human thing to do.
Now, beyond these specific concepts, the source material gives this great overview of different types of financial markets. We've talked about equity markets, but what are some of the other key markets out there?
Well, you have money markets, which deal in short-term debt securities.
Okay.
It's where governments and corporations go to raise short-term funds.
Got it.
Then you have bond markets,
Bond markets.
where you can invest in longer-term debt instruments
Yeah.
issued by governments and corporations.
So bonds are essentially loans that investors make to these entities.
That's it.
And then we have currency markets, right?
Yes, also known as Forex. It's actually the largest and most liquid financial market in the world where currencies are traded. The source material even details how these markets evolved from those simple currency exchanges to this complex global network we see today.
It's mind-boggling.
It is.
And finally, commodity markets. What are those all about?
Commodity markets deal in those raw materials like gold, oil, agricultural products. The building blocks of our economy.
Yeah, right.
The source material even mentions how the Chicago Board of Trade, one of the oldest commodity exchanges, initially struggled to attract traders.
Really?
They actually had to offer free lunch to get people in the door.
Wow. That's a fun fact. It's just interesting to see how far these markets have come. The source material also distinguishes between exchange markets and over-the-counter markets, or OTC markets. Can you explain those key differences?
So exchange markets are like organized marketplaces with standardized contracts and transparent pricing.
Like the New York Stock Exchange, the Bombay Stock Exchange?
Exactly. OTC markets, on the other hand, are more decentralized. Transactions occur directly between parties, often through dealer networks.
So OTC markets offer more flexibility, but maybe less transparency.
Exactly. And then, of course, we have derivatives, those often misunderstood financial instruments.
Derivatives always seem so mysterious. Can you demystify them a little bit for us?
Sure. Think of a derivative as this contract whose value is derived from an underlying asset. It could be a stock, a bond, a commodity, even the weather.
The weather.
The weather, yeah. Derivatives can be used for hedging, which is basically protecting yourself against risk, or for speculation, where you're betting on the future price movements of an asset.
So they can be tools for both managing risk and potentially amplifying returns, depending on how they're used. The source material highlights the growth of derivatives markets in India.
It has grown significantly. For example, the introduction of exchange-traded interest rate futures has been a huge development, allowing investors to manage their exposure to interest rate fluctuations.
Now, the source material also delves into the world of market intermediaries. Can you shed some light on who these players are and the roles they play in the financial ecosystem?
Absolutely. So you have merchant bankers.
Merchant bankers.
Who help companies go public through IPOs.
Okay.
Underwriters.
Underwriters.
Who guarantee the sale of securities to investors. Brokers, who facilitate trades between buyers and sellers. and then depository participants who handle the electronic custody of securities. It's a really complex web of interconnected players that keep the markets running smoothly.
It sounds like this really well-coordinated dance. Each player has this specific role, but this interconnectedness also raises questions about, trust and transparency.
Oh, absolutely.
Yeah.
And that's exactly where regulation comes in. The source material emphasizes the importance of SEBI's role in overseeing these intermediaries, making sure they operate ethically and protect investors' interests.
That makes sense. It's reassuring to know that those safeguards are in place. Now, let's talk about risk management, which is a critical aspect of navigating these financial markets. The source material highlights various types of risk that investors face. We already discussed market risk, but what are some of the other key risks to be aware of?
Well, there's credit risk.
Credit risk, right.
Which is the risk that a borrower might default on their debt obligations. This is particularly relevant when you're investing in bonds.
Oh, okay.
So if a company goes bankrupt, for example, bondholders might not receive their full principal or interest payments.
So assessing a company's creditworthiness is super crucial before investing in its bonds. What about operational risk?
Operational risk basically arises from those internal failures within a company or organization. It can be anything from fraud to system failures to natural disasters.
Oh, wow.
So think of a bank experiencing a major data breach. That would be an example of operational risk.
Okay, so it's the risk of something going wrong internally.
Exactly.
And then we have liquidity risk, right?
Yes. Liquidity risk is the risk that you might not be able to buy or sell an investment quickly enough at a fair price. This often applies to assets that are not frequently traded.
So if you need to sell an illiquid asset quickly, you might have to accept a much lower price just to find a buyer. The source material emphasizes the importance of diversification and understanding your risk tolerance as key elements of risk management. Can you elaborate on those concepts?
Sure. Diversification is this fundamental principle of investing.
Right.
Instead of putting all your eggs in one basket, you spread your investments across different asset classes, sectors, and geographies.
Don't put all your eggs in one basket.
Exactly. This way, if one investment performs poorly, it doesn't completely devastate your entire portfolio.
So diversification helps mitigate those losses by really spreading the risk. What about risk tolerance?
Risk tolerance is all about understanding how much risk you're comfortable taking on.
Right.
It depends on a lot of factors like your financial goals, your time horizon, and your emotional comfort with those market fluctuations.
So a younger investor with a much longer time horizon might be more comfortable with a higher risk portfolio, while someone nearing retirement might prefer a more conservative approach.
Exactly. And the source material also mentions those specific risk management techniques that are used by exchanges and investors. For instance, margin requirements ensure that investors have enough capital to cover potential losses in leveraged positions.
Okay.
Circuit breakers halt trading temporarily during those periods of extreme volatility to prevent panic selling.
So these mechanisms act as safeguards to prevent excessive risk-taking and to maintain that market stability.
They do.
Now, let's talk about market efficiency, which is a key concept that's explored in the source material. It touches on the idea of price discovery, or how the market actually determines the fair value of an asset. Can you explain that process?
Well, price discovery is kind of like this giant puzzle, really.
A giant puzzle.
It is. It's this continuous process where buyers and sellers evaluate new information, reassess their expectations, and adjust their bids and offers accordingly. Through this interplay of supply and demand, the market kind of arrives at this price that reflects the collective wisdom of all the participants.
So it's this ongoing negotiation, with the price fluctuating as new information enters the market and investors adjust their valuations.
That's a great way to put it. And in an efficient market, prices should accurately reflect all available information, making it really difficult to consistently outsmart the market.
But as we discussed earlier, markets aren't always perfectly efficient, are they?
No, they're not.
The source material acknowledges that psychological biases and information asymmetry can create distortions.
They can.
Right. Information asymmetry that occurs when one party to a transaction has more information than the other.
Right. And this can create an unfair advantage and lead to mispricing.
The source material even cites that Harshad Mehta's scam as an example of how information asymmetry can be exploited. Can you remind us of what happened there?
Sure. Harshad Mehta was a stockbroker who basically exploited loopholes in the Indian banking system to manipulate stock prices. He had access to information that most investors didn't, which allowed him to profit illegally.
It's a reminder that even in these regulated markets, Vulnerabilities can exist.
They do.
Now let's move on to stock valuation, which is a critical aspect of investing. The source material outlines several valuation models used by investors to determine the fair value of a company's stock. Can you walk us through some of these models?
Okay. One of the simplest methods is the book value method, which looks at a company's net worth. It's basically assets minus liabilities.
Okay.
However, this method doesn't really capture intangible assets like brand value or future growth potential.
So it provides a snapshot of the company's current financial position, but doesn't accurately reflect its true worth.
Right. Another common approach is the discounted cash flow model.
DCF.
DCF, right. This model estimates a company's future cash flows and discounts them back to their present value.
So it's like saying, what are those future earnings worth to me today?
Exactly.
That sounds more sophisticated, but it relies on predicting those future cash flows, which can be tricky.
It can be. There's always an element of uncertainty in any valuation model. And then we have those relative valuation techniques where you compare a company's valuation to that of its peers or to industry averages.
So if a company is trading at a lower price-to-earnings ratio than its competitors, it might be considered undervalued.
Potentially, yeah. But it's really important to consider why that discrepancy exists. It could be due to real differences in performance or those future prospects, not just market mispricing.
It's like comparing apples to oranges sometimes.
Sometimes, yeah.
The source material stresses the importance of combining those quantitative and qualitative factors when valuing a company. Can you elaborate on that a bit?
Sure. Quantitative factors are the numbers, right?
Right.
Those financial metrics like earnings, cash flow, and assets.
Yeah.
Qualitative factors are more subjective, like management quality, brand reputation, and those competitive advantages. A truly comprehensive valuation requires considering both sides of the coin.
So it's not just about crunching numbers, you really need to understand the story behind those numbers.
You do. Now, the source material also emphasizes the importance of research and analysis when making those informed investment decisions. What are some of those key resources that investors should be looking at?
Well, financial statements are definitely a must-read.
Absolutely. They provide a snapshot of a company's financial health, revealing its profitability, assets, liabilities, and cash flow.
And what about industry reports?
Industry reports provide valuable insights into market trends, those competitive landscapes, and those growth prospects. They help you understand that broader context in which a company operates.
And macroeconomic data.
Things like interest rates, inflation, and GDP growth paint that big picture view of the economy, which can significantly impact investment decisions.
It's like understanding the weather forecast before setting sail. You really need to know those prevailing economic winds. The source material also stresses the importance of staying informed about current events and news.
Oh, for sure. Geopolitical events, regulatory changes, technological advancements, all of these can have a ripple effect on financial markets. Informed investors are proactive investors.
It's like having your finger on the pulse of the world, anticipating those potential risks and opportunities.
Obviously.
Now let's shift gears a bit and talk about portfolio management, which is such a crucial aspect of investing. The source material highlights the importance of creating that diversified portfolio. Can you remind us why diversification is so important?
Sure. Diversification is all about managing risk.
Right.
By spreading your investments across different asset classes, sectors, and geographies, you reduce the impact of any single investment performing poorly. It's like that old adage, don't put all your eggs in one basket.
Exactly. So if one stock tanks, it doesn't sink your entire ship. The source material outlines various asset allocation strategies, from conservative to aggressive. Can you give us a quick overview of those approaches?
Of course. So a conservative portfolio might have a higher allocation to low-risk investments, like bonds,
Okay.
while an aggressive portfolio might lean more heavily towards those high-growth stocks. Your ideal asset allocation depends on your financial goals, your risk tolerance, and your time horizon.
So it's about finding that right balance between risk and return that really aligns with your individual circumstances. The source material also mentions the concept of rebalancing your portfolio periodically. Why is that important?
Well, over time, as your investments perform differently, your portfolio's asset allocation can drift away from your target weights.
Okay.
Rebalancing involves adjusting your holdings back to those targets, ensuring that your portfolio stays aligned with your risk tolerance and your financial goals.
So it's like course correcting to stay on track. Now, before making any investment decisions, the source material emphasizes the importance of understanding your own financial goals.
Absolutely. Setting clear financial goals is crucial for creating an investment strategy that works for you.
Right.
Are you saving for retirement? Buying a house? Funding your children's education? Each goal has different time horizons and risk considerations.
So knowing your why is essential. It helps determine your investment time horizon, risk tolerance, and ultimately the types of investments you choose.
It does, and the source material also encourages investors to create this financial plan. It doesn't have to be complex, but it should outline your goals, your income, expenses, and investment strategy.
It's like having a roadmap for your financial journey.
Huh?
Now, let's talk about investor psychology, which can play a significant role in those investment decisions. The source material delves into how emotions can really influence our choices, often leading to irrational behavior.
Yeah. Emotions like fear and greed can be such powerful drivers of investment decisions. Fear can cause investors to sell their investments at a loss during market downturns, while greed can lead them to chase hot stocks or invest in these risky schemes promising unrealistic returns.
It's like our emotions hijack our rational thinking.
Did you?
This source material talks about behavioral finance and how understanding these psychological biases can actually help us make better decisions.
Absolutely. Being aware of our biases allows us to recognize when we're letting emotions kind of cloud our judgment. For example, understanding loss aversion can help us avoid holding on to losing investments for too long just because we're afraid to realize a loss.
So it's about acknowledging our very human tendencies and developing strategies to kind of mitigate those biases.
It is.
The source material also emphasizes the importance of patience and discipline when it comes to investing.
Absolutely. Successful investing is a marathon, not a sprint. It requires this long-term perspective and the ability to resist those emotional impulses. The source material even talks about the power of compound interest, which works best over time.
It's like planting a tree and waiting for it to grow. You need to give it that time to really bear fruit.
You do.
Now, let's shift gears a bit and talk about those ethical considerations in investing, a topic that's gaining increasing attention.
Oh, yeah, for sure.
Ethical investing, also known as sustainable investing or socially responsible investing, involves considering the social and environmental impact of your investment decisions.
It's about aligning your investments with your values.
So it's not just about maximizing returns, but also about investing in companies that are doing good in the world.
Exactly. And the source material highlights that growing popularity of ESG investing,
ESG investing,
which
correct.
focuses on environmental, social, and governance factors.
Can you give us some examples of what those factors might be?
Well, environmental factors might include a company's carbon footprint or its efforts to reduce pollution.
Okay.
Social factors might involve its labor practices, its commitment to diversity and inclusion, or how it treats its suppliers.
Got it.
And governance factors might focus on transparency, board diversity, or executive compensation.
It's interesting how ESG investing considers those broader societal impacts.
It does. And for many investors, aligning their portfolios with their values adds another layer of meaning to their investments.
Now, we can't really talk about the evolution of finance without acknowledging that transformative role of technology.
Absolutely. Technology has completely revolutionized the financial industry, making those financial services more accessible, more efficient, and much more convenient. Think of online brokerages, robo-advisors, those mobile payment apps. They've all become completely commonplace.
I know, and the source material even mentions that rise of blockchain technology and cryptocurrencies as those potential disruptors in the financial world.
Yeah. Blockchain technology enables those secure and transparent transactions without needing those intermediaries. Cryptocurrencies, like Bitcoin, offer this decentralized alternative to traditional currencies. They've definitely captured the imagination of a lot of investors.
It's a rapidly evolving space, and it will be interesting to see how these technologies shape the future of finance. Now, the source material also stresses the importance of financial literacy. Why is it so crucial for individuals to be financially literate?
Well, financial literacy really empowers individuals to make those informed financial decisions, to manage their money effectively, and to achieve their financial goals. It's all about understanding those basic financial concepts like budgeting, saving, investing, and managing debt.
It's like having the tools and knowledge to build a really strong financial foundation.
That's a great way to put it. And financial literacy really benefits everyone, regardless of their income level or background.
Now, for those who might feel a bit overwhelmed by the complexities of finance, the source material highlights that role of financial advisors.
Yeah. Financial advisors can provide valuable guidance and support, helping you develop that financial plan, choose appropriate investments, and manage your portfolio.
But it's important to choose a financial advisor who is trustworthy, qualified, and really acts in your best interest. The source material emphasizes the importance of doing your research, asking those questions, and understanding the fees and services offered.
Absolutely. Transparency and communication are key to a successful relationship with a financial advisor.
It's like finding that trusted guide to really help you navigate that financial landscape. Now, the source material also stresses the importance of staying informed about those latest trends and developments in those financial markets.
Right. The financial world is constantly evolving, and it's so crucial to stay ahead of the curve. Reading financial news, attending webinars, consulting with those financial professionals, it can all help you keep your finger on the pulse.
It's like continuously updating your financial GPS to ensure you're on the right track. Now, let's talk about the importance of having that long-term investment perspective, a theme that runs throughout the source material.
Absolutely. Successful investing requires patience and discipline.
Right.
Resist that urge to make those impulsive decisions based on those short-term market fluctuations.
Easier said than done.
It is. It is.
Yeah.
The source material even uses that analogy of planting a seed and waiting for it to grow.
I love that analogy. You really need to give your investments that time to flourish.
You do. And the longer you invest, the more you benefit from the magic of compound interest, which Albert Einstein supposedly called the eighth wonder of the world.
So patience truly is a virtue when it comes to investing. Now, the source material also highlights the importance of protecting your investments from fraud and scams, which unfortunately are a reality in the financial world.
They are. There are always those bad actors looking to take advantage of unsuspecting investors. The source material outlines some red flags to watch out for, like promises of guaranteed returns, those high-pressure sales tactics, and unregistered investment opportunities.
So if something sounds too good to be true, it probably is.
Probably is, yeah. Do your research, ask questions, and verify the legitimacy of any investment opportunity before committing your money. And if you suspect fraud, don't hesitate to report it to the appropriate authorities.
It's like protecting yourself from those financial predators.
Exactly.
Now, let's talk about the importance of having that contingency plan in case the unexpected happens.
Oh, yeah. Life is full of surprises, and it's absolutely crucial to be prepared for those financial setbacks. The source material emphasizes the importance of having an emergency fund, adequate insurance coverage, and a will or trust.
So it's about creating that financial safety net for yourself and your loved ones.
It is. An emergency fund should cover at least 3 to 6 months of living expenses, providing that cushion in case of job loss, illness, or those other unexpected events. Insurance, such as health, disability, and life insurance, can protect you from financial ruin in those cases of accidents, illness, or death.
And a will or trust ensures that your assets are distributed according to your wishes after you're gone.
Right. These are all those essential elements of a sound financial plan.
Now, the source material also encourages readers to seek that professional help when needed.
Absolutely. Sometimes navigating those complexities of finance requires expert guidance. Financial advisors, tax professionals, estate planning attorneys, they can all provide specialized knowledge and support.
But as we discussed earlier, it's crucial to choose those professionals very carefully, ensuring they're qualified, trustworthy, and acting in your best interest.
For sure. Don't hesitate to ask questions, understand their fees, and make sure you really feel comfortable with their advice.
It's like assembling a team of experts to help you achieve those financial goals.
It is. You don't have to go it alone. Now, the source material also stresses the importance of staying motivated and engaged in your financial journey, which, let's be honest, can sometimes feel a bit overwhelming.
It can. It's easy to get bogged down in those day-to-day details and lose sight of that bigger picture.
Absolutely. The source material suggests setting small, achievable goals, celebrating those milestones along the way, and seeking support from those friends or family.
It's like breaking down a marathon into those smaller, manageable segments.
Right. And remember why you started this journey in the first place. Focus on that positive impact that financial well-being can have on your life and those you care about.
It's about finding that joy and purpose in the process.
It is.
Now let's talk about the importance of giving back to your community and supporting causes you care about.
Yeah, financial well-being isn't just about accumulating wealth. It's also about using your resources to make a positive impact on the world.
The source material talks about aligning your financial decisions with your values.
Exactly. Donating to charities, volunteering your time, or even investing in those socially responsible companies can add another dimension of meaning to your financial journey.
So it's about recognizing that we're all part of this larger community and using our resources to make a difference.
We are. Giving back can really enrich your life and create a ripple effect of positive change. Now, the source material also encourages readers to cultivate a growth mindset when it comes to their finances. Can you explain what that means?
Yeah, what does that mean?
Well, a growth mindset basically believes that your abilities and your intelligence can be developed through hard work, learning, and perseverance. It's about embracing those challenges, seeking out feedback, and constantly striving to improve.
So it's about believing in your capacity to learn and grow financially.
It is. It's about recognizing that you're not stuck where you are.
Yeah.
You can always acquire new knowledge, develop new skills, and make better financial decisions.
It's a very empowering perspective.
It is.
Now, the source material also emphasizes the importance of enjoying the journey and celebrating those successes along the way.
Right. Financial well-being isn't just about reaching a destination. It's about savoring those experiences and those accomplishments along the way. Take the time to appreciate how far you've come, acknowledge your progress, and celebrate those milestones.
It's about finding that fulfillment in the process, not just the outcome.
Exactly. And the source material even encourages readers to think about leaving a legacy that extends beyond their financial assets.
That's a really powerful concept. What does that mean in a financial context?
Well, it's about the impact you make on the world and those memories you leave behind. It could involve sharing your financial knowledge with others, mentoring young people, or supporting those causes that are close to your heart.
So it's about using your financial resources to create a positive impact that really extends beyond your own lifetime.
Absolutely. It's about making a difference in the world and leaving behind a legacy that you're truly proud of.
It's amazing how much we covered in this deep dive into financial markets. From the very beginnings of markets to the psychology of investors, we really went deep. What stands out to you as the most significant takeaway for our listener?
I think the overall theme has to be empowerment. By understanding what drives financial markets, from the actual mechanics of trading to investor psychology, we can make smarter choices. Take control of our financial futures.
Totally. It's not about becoming a financial guru overnight, but more about just getting the knowledge and the tools to navigate this crazy world with a little more confidence.
Exactly.
So for our listener who's been on this journey with us, let's try to distill a few key takeaways from everything we've discussed.
Okay, sounds good.
First and foremost, financial markets are basically bridges connecting those with capital to those who need it. That's a core principle that drives economic growth and opportunity, wouldn't you say?
Absolutely. It's foundational.
We also discovered how this flow of capital occurs through all sorts of financial instruments, each with its own quirks and risks. Whether we're talking about stocks, bonds, derivatives, or anything else, understanding those is critical.
For sure. And don't forget those history lessons.
Oh, yeah.
Tulip mania, the Harshad Mehta scam, the 2008 financial crisis. They all teach us that markets are not always rational, and that manipulation and systemic risks are very real things.
It's like learning from the past to get ready for the future.
Precisely.
We also took a deep dive into the Indian financial ecosystem, exploring those roles of key players like the RBI and SEBI, not to mention all those intermediaries that keep the markets running. What a complex system.
It is. Understanding the regulatory framework and those safeguards designed to protect investors is so important. Knowing that there are rules and oversight gives us the confidence to actually participate in the markets.
For sure. We even explored some pretty advanced concepts, things that can seem a bit intimidating at first, the efficient market hypothesis, the capital asset pricing model, and behavioral finance. But ultimately, these concepts, even though they're complex, offer some really valuable insights into market dynamics and how investors behave. What do you think?
Absolutely. They really challenge our assumptions and make us think more critically about how markets actually work and how our own biases can affect our decisions.
It's a good reality check. And throughout our deep dive, we emphasize the importance of research, analysis, and always continuing to learn. Staying informed is really the key to navigating this ever-changing financial world.
It's about being a lifelong learner, always looking for knowledge from credible sources and just being curious about those new trends and developments.
Always learning. So as we wrap up this deep dive, what's one last thought-provoking idea we can leave our listener with?
I'd say encourage our listener to think beyond those traditional investments. The source material mentioned a few alternative investment approaches, like venture capital or real estate, maybe even peer-to-peer lending. These options could offer diversification and maybe even higher returns. But it's super important to understand the risks that come with them and to do your research.
Such a good point. It's about expanding our options and looking at different paths to reach our financial goals. And remember, dear listener, your financial journey is unique to you. Embrace learning new things, ask for help when you need it, and most importantly, enjoy the ride. Who knows what exciting opportunities await? Thanks for joining us on this deep dive, and until next time.